Why do prices seem to sprint ahead while wages just jog behind? It's one of those questions everyone asks at some point, especially when the grocery bill feels like a small mortgage. You get a raise, maybe 3%. You're happy for a week until you realize that milk, rent, and gas have all quietly gone up by 5. It's that sinking feeling. You're moving forward, but the treadmill is speeding up faster. Let's unpack why wages almost never catch up with prices. Part of it starts with inflation, not just the number you see on the news, but what it actually means in daily life. Inflation is a measure of how much prices rise over time. In theory, wages should rise alongside it. If prices go up 4% and your pay goes up 4%, you're fine, right? But in practice, it rarely works that cleanly. Take the United States over the last few years. Between 2020 and 2023, consumer prices rose roughly 17% in total, but average hourly earnings only rose about 14% in that same window. That gap, 3%, doesn't sound huge on paper, but it means thousands of dollars in lost purchasing power for the average worker. So why does this gap happen? Because prices can move almost overnight, wages can't. Think about how prices change. A company sees higher costs for materials or shipping, and they can adjust prices next week. They just print new menus, change tags, or update the website. But changing wages is a much slower process. It involves contracts, budgets, corporate approvals, and sometimes union negotiations. That lag, even a few months, means workers are always reacting to inflation instead of staying ahead of it. There's also psychology. Businesses are quick to raise prices when their costs go up, but slow to raise wages when profits go up. Economists call this asymmetric adjustment. It's like a thermostat that only works in one direction. Let's take an example. In 2021 and 2022, global companies reported record profits. The S&P 500's profit margins hit 12%, the highest in decades. Yet wage growth during that same period averaged only around 5%. Companies were making more, but not necessarily paying more. That's partly because wages are treated as a fixed cost, while prices are a flexible lever. It's easier to change the price of a burger than to rewrite payroll for every employee. Now, some people think the market will fix this, that labor shortages will force companies to raise pay faster, and that can happen in specific sectors. After the pandemic, for instance, restaurant and warehouse jobs saw wage jumps of 10 to 15%. But once the supply of workers normalized, wage growth cooled again. It's a temporary spike, not a new baseline. Another factor is productivity, how much output each worker creates per hour. For most of the 20th century, productivity and wages grew together. From 1948 to 1973 in the US, productivity rose 97% and hourly compensation rose 91%. That was almost a one-to-one relationship. But after the mid-1970s, the link broke. From 1973 to 2023, productivity jumped about 65%, while wages rose only 17% after adjusting for inflation. That's a massive divergence, and it explains why the average worker today can produce more but doesn't necessarily earn more. So why did that connection break? Globalization is a big part of it. When companies can hire workers overseas at lower wages, it weakens wage bargaining power at home. A manufacturer in Michigan can't easily demand a 10% raise if the company can move production to Vietnam or Mexico. This global labor pool keeps wage growth in check, even while corporate profits rise. Technology also plays a role. Automation and software make businesses more efficient, but they don't always translate into higher pay for workers. When a company invests in machines or AI that replace part of a job, it reduces labor demand, which caps wage growth. And that effect compounds over time. A single robot or algorithm doesn't just replace one worker, it can flatten wage growth across an entire industry. Now let's talk about inflation expectations, how people think prices will move. When inflation rises quickly, workers start asking for higher pay to keep up. But employers resist because they fear a wage price spiral, the idea that higher wages cause higher prices, which then cause higher wages again. Central banks like the Federal Reserve are especially cautious about that spiral. That's why policymakers often raise interest rates to cool wage growth when inflation spikes. Ironically, that means the very institution trying to protect purchasing power can unintentionally slow wage increases. In 2022, the Fed raised interest rates from near zero to over 4% in less than a year, the fastest pace in decades. That slowed inflation from 9% to around 3 or 4%. But it also cooled the job market, reducing workers' ability to negotiate higher pay. Inflation came down, but wage growth stalled too. Prices stopped rising as fast, yet they didn't fall back to old levels, so the gap between wages and prices simply froze in place. And it's not just a US issue. In the UK, real wages, meaning inflation-adjusted pay, were still lower in 2023 than they were back in 2008. That's 15 years of stagnation. In Japan, wages have been flat for almost 30 years, despite rising living costs. Even in fast-growing economies like India or Brazil, inflation often outpaces nominal wage growth. It's a global pattern. The treadmill is everywhere. But there's another layer, the difference between average wages and median wages. When economists talk about average earnings, big salaries can skew the numbers. If a few executives make millions, it pushes up the average, even if most workers see no change. The median, the midpoint, gives a clearer picture. And that median has barely moved. According to the Bureau of Labor Statistics, the median weekly earnings for full-time workers rose about 4% in 2023, while inflation was 3.4%. That sounds like a small gain, until you remember that the year before, inflation outpaced wages, so real purchasing power is still trying to crawl back to where it was before the pandemic. Let's look at a simple scenario. Say you earned $50,000 in 2019. Prices have risen roughly 20% since then. To have the same buying power today, you'd need to earn around $60,000. But average wages have only risen about 15%. That leaves a shortfall of $2,500 to $3,000 a year. That's a month of rent or half a year of groceries gone. And this gap doesn't affect everyone equally. Low and middle-income households feel it the most because they spend a larger share of their income on essentials, food, housing, energy, which have risen faster than luxury goods. For example, the cost of shelter in the US rose 7% in 2023, and groceries rose around 5%. Meanwhile, electronics and apparel barely moved. If you spend most of your paycheck on rent and food, you feel inflation much more intensely than someone whose budget goes to vacations or stocks. Some economists argue that wages will eventually catch up as markets adjust, but historically, that catch-up is slow, sometimes a decade or more. After the oil shocks of the 1970s, real wages in America didn't fully recover until the mid-1980s, and even then, it was uneven. Higher-skilled workers regained ground faster, while lower-wage workers lagged behind. Policy choices also shaped this dynamic. Minimum wage laws, labor union strength, and tax policies all determine how the pie gets divided. Union membership in the US has fallen from over 20% in 1983 to just about 10% today. That's a major reason bargaining power has weakened. In countries where unions remain strong, like Sweden or Germany, wage growth has kept closer pace with inflation. But those systems also accept higher prices as a trade-off, so consumers still feel the pinch. There's also the time lag between inflation and wage adjustments in public sectors. Teachers, nurses, and government employees often see raises negotiated annually or even biannually. So when inflation spikes mid-year, their pay doesn't adjust until the next contract cycle. By then, the lost purchasing power is already baked in. Now, here's the tricky psychological part, something economists call money illusion. People focus on nominal wages, the number printed on the paycheck, not the real value after inflation. If you get a 5% raise, it feels good, even if prices have risen 6%. That illusion keeps wage pressure lower than it might otherwise be, because many workers don't immediately feel the erosion. It's only months later when bills pile up that they realize the raise vanished into thin air. Another subtle factor is corporate structure. In the modern economy, many jobs are outsourced or gig-based. A delivery driver or freelance designer doesn't negotiate with one employee. They compete in a marketplace where rates are set algorithmically. That limits the collective power to demand higher pay. When millions of workers are fragmented across apps and short-term contracts, wage coordination becomes almost impossible. Meanwhile, asset prices, homes, stocks, even cars, keep rising faster than income. That widens the wealth gap. Those who already own assets benefit from inflation because their holdings appreciate. Those who rely only on wages fall further behind.
Between 2019 and 2023, U.S. household wealth rose by about $30 trillion, but most of that went to the top 10% of earners. So even as the economy grew, the average paycheck didn't feel it. Some might ask, why can't we just raise wages across the board? Well, if wages jump too fast without matching productivity, businesses pass that cost on to prices, creating another round of inflation. It's a delicate balance. If inflation runs hotter than wage growth, workers lose. If wages run hotter than productivity, businesses lose. And eventually, jobs do too. That tug of war is what makes the economy feel like a perpetual catch-up game. There are solutions, but none are simple. Improving worker productivity through education and technology helps in the long run. Policies that link pay growth to inflation, sometimes called indexing, can maintain purchasing power, though they risk fueling more inflation if not carefully managed. Expanding profit sharing, employee ownership, or stronger wage transparency can also help close the gap. But these ideas require political will, and that's often the hardest currency to find. So, what should the average person do in the meantime? Understanding the pattern helps. If you know wages lag behind prices, you can plan around it. Negotiate raises with inflation data in hand. Diversify your income through side projects or passive income, and wherever possible, invest in assets that tend to rise with inflation, like index funds or real estate. Because the truth is, the system rarely hands out equal gains. You have to position yourself to capture them. It's easy to feel powerless when the cost of living keeps climbing, but awareness is the first defense. Money is not just about math, it's about timing and leverage. And knowing that wages will likely trail prices helps you think strategically, not emotionally. So, next time you see headlines about record profits or rising inflation, remember, prices can move in a day, but wages move in seasons. One responds to pressure, the other responds to politics, contracts, and time. That's why for most of us, the paycheck always seems one step behind the price tag. If you found this breakdown helpful, subscribe to Taz's Money. We dive deep into the real stories behind the numbers every week. Because understanding how money moves isn't just economics, it's survival.